Hey everyone, here Chris Urso with Urso Capital Partners. So, we're going to do our Q3 2024 update. So, those of you that have never seen one, doing this, I think this is now our sixth consecutive quarter of putting this out there, basically giving you an insight to all of our KPIs within the operating side. Just given the environment that we're in, we felt that this was a good kind of routine to get into to share with our current investors, and then any of you that are out there interested in the market and or potentially investing with Urso Capital in the future, give you some insight into our portfolio as a whole and what we're seeing both on operations, and then touch a little bit about our acquisition side and what we're looking for in the market. So I'm going to try to keep it pretty concise here. This is actually Q3, not Q2, so apologize for the typo. But since inception, we're at 28 properties. We just closed on one a couple weeks ago, about 3 weeks ago. So 28 properties, close to 5,000 units acquired, and a little over 1,000 units of ground up development. We've sold 23 assets since inception. So over the last, pretty much since 2019 to early 2024, we divested out of probably about 12 or 13 of those 23 sold deals. Happened in 2019 to 2024 period. Just pricing got a little bit out of control, a lot out of control. We decided to skinny down the portfolio, focus on high quality assets that we wanted to own for the long term, and then when the time was right, start to go out and acquire again. So across those deals sold, we've averaged a 32% IRR, equity multiple of 2.07 with an average hold time of just shy of 40 months. Lighting in here is a little rough today, sorry. So Q3, a couple things on the Urso Capital front. We acquired this beauty here. Distressed 126 unit deal. Got a lead on it through one of our broker relationships. Situation where just kind of everything that we've heard about and been tracking, just good example of good asset, good market, good owners even, just got caught on the wrong side of pricing and interest rates. So came in and bought the deal in 2022 at a pretty aggressive number, financed it with floating rate debt. I don't believe there was a rate cap in place, so that then spurred negative cash flow situation. Property was getting sucked of resources, and therefore occupancy dipped to well below market levels. We closed on the property for $21 million, all cash, in less than 30 days. So we knew it was a time sensitive deal. They had a loan event coming up that they needed to close by, and we were able to execute literally from contract to close in 30 days. $21 million, all cash. So we're now in the process of doing our, bringing our team in there, stabilizing the asset, the operations, curing work orders, fixing the pool, power washing, etc., getting this back to a fully functional community. Leland happens to be one of the fastest growing towns in all of North Carolina, so we're excited for the long term on this asset. Good vintage, 2006, so really check the box of kind of market we'd like to be in for the next 10 years, asset we'd like to own for the next 10 years if need be, and capitalized, very safely to own it. Our goal will be to stabilize the asset and then ultimately put Fannie Mae financing on it and return a large portion of our capital. We also had another great acquisition in the third quarter. This was the Oaks at Broad River, which we've since rebranded to Views at Broad River. Great asset, 2000, I want to say this is 2001 construction. So good kind of institutional deal here, 248 units, good floor plans, great amenity package, on the marsh, Beaufort, South Carolina. So Hilton Head MSA, Savannah Hilton Head MSA, great town, great demos, great everything. Bought this off market to facilitate a 1031 exchange from a deal we had sold earlier this year in Savannah. And we're able to acquire this from a long-term owner, 15-year owner, operator. Property was really 100% original. Outside the exterior paint job, all the units are original, the amenities are all original, but it had great bones. The floor plans were great, the amenities were great. So we're going in, and we've actually, the progress we've had, it's only been just not even 3 months now, and it feels like a completely different property. So we're redoing the fitness, the gym, outdoor club rooms, grills, pergolas, fire pits, decking, and then doing a strategic unit renovation simultaneously. So really great asset. We acquired this with an awesome loan in place, blended at 3.95%. We were able to get supplemental financing going in, so we brought about just shy of $21 million of cash to this deal. We did a low leveraged loan assumption. So super excited. Good asset. Two great assets. These mark our second and third acquisitions of 2024. We have another deal under contract as well, which I'll touch on later. And we want to continue to acquire one deal. Ideally a deal a quarter is the perfect world for us. So on the URS property side, this is our in-house management side. Across the portfolio, we have 8 communities, a little over 1,800 units, plus a 319 unit under development in Asheville, North Carolina. So first off, I want to thank everybody that reached out. Knowing that we have a development in Asheville, our site was unimpacted at all, and I actually went down there literally within a couple of days after the storm came through. We flew into Charlotte, loaded up a truck, went down to Asheville, just to our site to drop off a bunch of supplies, and then drove around, literally just opened up the trunk at other apartment communities or utility crews. It's definitely making a ton of progress. So I know what we've seen on the news has been, the areas of devastation, which is real, for sure. But I am very grateful that our development site has been back at 100% capacity, really for the last now 2.5 weeks. And we believe in Asheville for the long term. They're very resilient. They're very positive. It's a great city. This was a 1 in 1,000 year event, and it was good to hear. I think Biltmore is reopening up actually in a couple weeks in November, which is huge for the city. It's just such an anchor destination, the Biltmore estate. So don't want to digress too much, but just want to say thank you. A lot of you reached out and showed your support, so definitely appreciate that. But URS Properties, we couldn't be more proud of our management team here, led by Molly, who's our director of property management, and her team that really works day in and day out across our portfolio. We're super hands-on. We really take a team approach to this, and we couldn't be more proud of the assets we have and the team that we have in place. So Belmont Heights, I'm going to talk about a couple of our metrics here. So we'll stick to some of the basics to start out. Belmont Heights is in Belmont, North Carolina, about 20 minutes from uptown Charlotte, give or take. 176 units. We bought this in January of this year. So in the form of leads, we had about 275 leads that came in from all different sources of traffic, right? So that's online websites, apartments.com, Zillow, drive-bys, phone calls, emails, etc. That equated to 81 tours, and we netted only about 17 leases there. So a little bit lighter than we'd love in terms of ratio of net leases to tours, but good overall traffic. Occupancy closed out the quarter at 95%, very strong. Deal's doing really well. Crescent Place in Savannah, Georgia, 232 units. Saw 285 pieces of leads of traffic, which equated to 55 tours and 21 leases. So pretty good ratio there, almost 50% on that. And close out the Q. We are experiencing a little bit of softness on occupancy, going down from 96 to 92.7% to quarter over quarter there. So definitely kind of a market-wide, little bit soft. We're working on our outreach, on our resident events. Kind of a common theme in most markets, to be honest with you right now. Any of these growth markets that we're all in and we love for the long term, have been preparing, honestly, for the last kind of year and a half. And I personally feel like it's starting to come to a head. Really, Q4 of this year and probably Q1, Q2 of next year are going to be a challenge. And it's not a demand issue necessarily. It's a supply issue. The demand has been stronger than it's been probably in the last 20 years in regards to absorption of apartments, which is what most people aren't seeing. And we're going to get that out actually in a newsletter update in the next month or so. really highlighting the amount of absorption and demand that there is. So it's a super healthy market on the demand side. We're just seeing supply really cresting now and peaking in terms of the form of deliveries. Therefore, it's a trickle-down effect of softening around on occupancy, right? Because there's more units available, and it's going to take a little bit more time to get those units absorbed. So we're preparing for what we think is going to be a bit of a challenge over the next 3 to 6 months on operations, but it's being ahead of it, right? Being proactive, knowing we're going to have to work twice as hard. Sorry, let me get that out of the way. Knowing we're going to have to work twice as hard, to maintain the occupancy levels that we strive for day in and day out, which is 95% across the board. So that's Crescent Place in Savannah. Latitude at South Portland closed out the quarter at 98%. 271 leads, 77 tours, 18 leases. That's a function of availability as well for the quarter. Exchange at Rock Hill, really the traffic was great all around. This was a fairly slow lease up for us. It's been stabilized now since pretty much the beginning of this year. We refinanced it earlier this year, so we're now in our agency financing, and we're at a point where we're just operating. This is Opportunity Zone, brand new development, phenomenal asset. We're operating for the long term. Closed out pretty much dead on where we were prior quarter, just shy of 93%. It's going to be probably a little bit bumpy again, supply story in and around Charlotte. We expected, but again, I can't stress enough, like this is the exact reason why we do these updates, right? Because there's so many conflicting storylines that are out there in our space, and the only way to get kind of this is the actuals. This is what's happening day in and day out across our portfolio. So fundamentally, we think we continue to believe that we are in one of the best sectors that exists when it comes to commercial real estate, if not the best, which is proven out to be. But not only that, I think on the backside, 2 to 3 years out, we're going into this world very defensively, and we really think that there's a lot of ability to be surprised to the upside in the form of occupancy growth and rent growth. Because while supply is peaking today, it's going to materially drop off come 26, 27 in the form of deliveries, but demand remains to continue to be extremely healthy and strong from an historical perspective, far exceeding some of the best years that have ever happened in multifamily absorption in this past year. So we think overall underlying fundamentals are really, really strong, but got to be honest about where we are today. It's going to be a dogfight, and that's what we're prepared for day in and day out. That's why we have the processes in place. Is to put out the best products in our spaces, in our markets, and the best teams that we could possibly put together to run these assets. So Exchange at Rock Hill, touched on that. Views at River Bend, which we just took over. Great first, not even a quarter. I mean, I think we closed in end of August. So great traffic. 39 tours, 20 leases. I'll take that all day. We stepped in, occupancy was right around 89%, so it was an extended contract period, and operations really kind of dipped off from previous seller. Just under contract for sale, lack of staff, lack of attention. It's not uncommon, when you're buying a deal to see operations really start to slide because the staff knows it's for sale. We weren't hiring any of the staff. So we saw operations dip a bit. But again, we're in like our reposition mode right now where, this property is going to be massively transformed between now and the end of this year. And we're really gearing up for spring leasing season. So no concerns from us there. Farmhouse Apartments, we are in our final stages of lease up here. Tremendous amount of traffic and tours and leases for the quarter. We're at 88.5% occupied at the close of the quarter, so we're just bumping up on our magic number of 90%, and then we'll set our sights on 95%. So that's a very seasonal market. I can pretty much guarantee Q4 you're going to see those numbers drop dramatically. We saw this play out last year, and then really come like February, March, it starts to explode again. The market just, each market has its own little nuances, but Murfreesboro, the growth story continues to be real. Continues to make top 10 lists across the country for fastest growing cities. throughout the country. So tremendous job growth, population growth. It's about 30 minutes south of Nashville, 35 minutes south of Nashville. Just a really great city. We're long-term on farmhouse apartments as well, opportunity zone, beautiful asset. Cobalt Row is our student housing asset in the same market, Murfreesboro, Tennessee, servicing Middle Tennessee State University. We are 100% leased and occupied for the 24-25 school year. Those move-ins occurred in the end of August. Great asset. It's best in class. Really well performing. We bought this during COVID. Great piece of real estate and something that we plan on holding for the foreseeable future. So we have, now we'll talk a little bit about move-ins and then some of the average increases on the rent side. So Belmont Heights had 21 move-ins, average increase over prior rent on that same unit, 10%. 21 renewals, 16 move-outs, average increase on renewals, 6.3%. Crescent Place, 23 move-ins, 5.9% increase on those units. 25 renewals, 31 move-outs, 4% increase on renewals. So, I mean, these are some pretty strong numbers for the first three here. Portland, Latitude South Portland, 31 move-in, 24 move-ins, 6.6% growth on same unit trade out. 43 renewals, 6.3%. So we're averaging, just about 5%, give or take, probably a little bit higher, 5.5% on renewals for these three assets, and close to 7%-ish on new lease trade outs. Exchange at Rock Hill on the other side, pretty much flat on our move-ins. We did have 48 move-ins, so a lot of activity, a lot of traffic, which was great to see for this property. Look at the prior quarter, only at 29. We went to 48. Sorry, got a little bit of a stuffy nose here, and pretty much flat on those move-ins. 44 renewals, pretty much flat, 1.2%. Views at River Bend, this is kind of choppy here. 17 move-ins. A lot of these were inherited move-ins from prior operations, prior management, where they had move-ins, approved for when we took over. Pretty much flat. Renewals were not going gangbusters. Again, we've only been in there about 30 days for this quarter. The month of September was our first full month, so 2.3%. Since then, the transformation that's happened just in the last 45 days is huge, and you'll start to see these numbers really tick upward. Farmhouse apartments, pretty much flat on move-ins, 67 and 67, which is huge. Obviously, you could see our best performer in terms of move-ins, but rents on any of those same units that were previously occupied, pretty much flat. Renewals, 2%. It's all about maintaining renewals right now and getting to that 95% occupancy. We've already far exceeded our rent projections for this, so there's no reason for us to try to push any further at this point. Right now, all things are focused on occupancy at this particular property. Cobalt Row saw about 459 move-ins. That's it all happens at once on a student housing property. So from pretty much August 17th to the 31st, it's all by the bed too. So we'll have a 4-bedroom house where there's 4 move-ins in that house. Each student gets their own bedroom, obviously. So tremendous growth, about 12% on our new leases, which was huge year over year, and about 5% on renewals, which is still fantastic. So really happy overall with the progress here on all sides. So you're not seeing. I know there's a lot of headlines out there too about rents declining, and when we talk to investors, it's so market by market, asset profile by asset profile, sub-market by sub-market driven. It's really hard to make blanket statements and say, rents are going down, rents are getting soft, demand is down, occupancy is down. Demand is not down, is very evident by the amount of move-ins and traffic and leads and tours that we're getting consistently month over month, quarter over quarter. This is really just a function of balancing out the supply and absorbing the excess supply there. So bad debt, this is another question we get a lot about. We're still seeing our residents are holding up really well for the most part. Nothing too alarming here. You can see pretty consistent quarter over quarter. Views at Riverbend, again, these numbers, until we get 2-3 quarters deep, we're implementing policies, procedures where, policies have been pretty relaxed. So that bad debt number is going to be very choppy. But you could see pretty much the rest of the portfolio pretty consistent overall, and nothing too outside of the ordinary. So NOI, obviously one of the biggest KPIs, or the biggest in our space. So we have quarter over quarter growth at Belmont Heights of 3%, Crescent Place down 2%. It's really a function of the vacancy. If you can remember, we went from 4.5-5% vacancy in Q2 to about 7-8% vacancy in Q3, and a little bit more turnover, expense, etc. Portland, great incremental growth, 4%. Exchange at Rock Hill, this is down, mainly driven by occupancy and some heavier expenses on turns that we experience, right, due to higher vacancy, more turns, and some utility adjustments for the quarter. So, I want to see how this kind of plays out. Next quarter should start to normalize here, and it'll be interesting to see. I think we reverse that trend that we see here. Views at Riverbend, nothing to really report there. Farmhouse Apartments, good consistent growth quarter over quarter. That number is going to really shoot up in about 3 to 4 months. You're going to see some significant growth, because right now we're utilizing concessions, right? So every new move-in is getting a month to 2 months free, just to basically get that occupancy where we need to get it to. And that's pretty much for every lease up that exists right now. We went from 1 month to 1.5 to 2. Some markets we're hearing in downtown Nashville, 3 months of free rent. And this is all because it goes back to what I was talking about earlier, where I really feel like supply is hitting that big inflection point where the dump is happening now through the first 2 quarters of next year. And I think that's probably going to be the biggest challenge for everybody that's in lease up, is going to be over the next kind of 6 to 18 months until that product gets absorbed. So year over year on NOI, Cobalt Row, I don't want to leave them out. 924 versus 897, up 3%. So year over year, Belmont Heights we haven't had for a year yet, but Crescent Place, phenomenal growth there. We bought this in June of 2022. We did a bridge loan on it. It was the only deal we did with floating rate bridge debt, and we executed flawlessly. Look at the NOI growth there just in 1 year, and that's the second year of growth. So we're probably up almost 50-60% on our NOI, but a lot of that got evaporated through cost of capital, interest rates going up 400 or 500%. So we were able to refinance. We're in fixed rate debt now for Fannie Mae and Freddie Mac, but we were basically cash neutral, where historically you would think for that type of growth and execution you should be able to refinance and pull out a ton of cash to return. But you know what? This was one, but it's a great asset. It's mostly townhomes, 80% townhomes. We really are bullish on Savannah. The growth story down there has been tremendous. I think it's going to be a great workforce product for many, many years to come. Portland's up meaningful, 12% year over year, which is great because that's a steady, that's a stabilized asset. Exchange at Rock Hill, this is a function of getting to stabilization this year versus last year. Views at Riverbend, nothing to report there. Farmhouse Apartments, obviously up materially because it's in lease up. And Cobalt Row, went from, that's huge growth year over year too, 14%. Work orders, this is the backbone of all of our communities, is our maintenance teams. Sorry about that. I have the window open today. It's beautiful out. I'll take this in October any day of the week. It's almost 75 degrees here in Long Island. So Belmont Heights, 276 work orders, 276 completed with 2 techs. Crescent Place, 401 work orders, 3 techs. Crescent Place is 1970s vintage, so a lot of older AC units. These guys get a ton of calls on top of doing turn work, on top of doing grounds. There's never enough that could be said for having a great maintenance team. Latitude at South Portland, 221 work orders with 2 techs, 292 at Exchange with 2 techs. Views at Riverbend, 264 with 3. Farmhouse Apartments, 623. Now, a lot of this is move-in work orders, right? So because we have so many move-ins, it could be somebody moves in, a week later they realize maybe a light bulb, blew out. Things like that. These are not very complicated work orders as of yet. Knock on wood. Cobalt Row, over 1,000 work orders. This is because of turn season, really. That's what loads up all that. But, I think a lot of people are surprised when they see these numbers, and I think it's important to share because many people don't realize what goes into operating these assets and how much attention you have to give to each one of these metrics that that I just touched on in a matter of 25, 30 minutes. From your traffic sources to your leads to your tours to your conversions to your leasing people to your maintenance teams, your renewals, your days vacant, etc. There's really a lot that goes into this on all fronts, and we couldn't do it without our team at URS Properties. So from an URS Cap perspective, on the investment side of things, we do have another deal, our 4th deal under contract here in Asheville. All these assets actually held up extremely well, unimpaired in their entirety. They all have power, water, no physical issues, no water issues, etc. So, again, just going back to Asheville, like being from Long Island, New York, like we experienced Hurricane Sandy years back, and you could go to parts of Long Island and it looked like the world was going to come to an end. Like it was just, awful devastation. And then you can go 10 minutes in another direction and you'd see maybe a tree down, a little bit of debris, but everything kind of functioning. That's really kind of the similar tale in Asheville, where there's pockets of extreme devastation, but there's also, large portion. Asheville, I think, is a lot bigger than most people expect too. I think there's almost 370,000 people that make up the Asheville MSA, which is fairly large for these smaller secondary cities in and around the South. So there's a lot that was really unimpacted, a lot of folks that are really stepping up and helping those in need. And we're starting to see great response both on a state level, finally on a federal level, which was a little bit slower than we all would have liked to see. But these particular deals, we are under contract. We are delaying closing. We want to make sure collections are good. We're trying to put together some backstops here. For the uncertainty that comes, right? Because the deal did change a bit. So there is some uncertainty between, what was and what is. But we think these are really durable defensive deals where they're the lowest rents in all of Asheville, literally going in at, $1,100 rents. And we think that there's a great opportunity here to provide good workforce housing, especially with the amount of rebuilding efforts that are going to take shape over the next 12 to 24 months. And they come with fixed rate debt at 3.4% for 9 years. This deal is fully subscribed. We're really kind of just, waiting on a closing timeline at this point. And going forward, we're going to maintain our strategy. We really, we bought so little in 21, 22, 23, waiting for this moment to come, over the last 5-6 years. And we're really well prepared. We're super grateful for the amazing investor base that we have that's allowed us to already get 3 deals done this year with the 4th under contract to close. And there's no signs of us wanting to slow down. It's taking a lot of work to find those deals. We've underwritten probably close to 200 deals so far this year. There's a lot of product being floated around there. We still believe the data doesn't lie. I stare at the loan assumptions. I stare at the loan maturities that are out there, the prices that were paid. There is pressure that's mounting behind the scenes, and with the 10-year still hovering at 4%, it's not making it any easier to relieve that pressure for those folks that acquired in 21 and 22 at peak pricing with short-term floating rate financing. That's now hitting their 3-year maturity or 2-year maturity, and now they're trying to get an extension. Yes, rate caps are getting cheaper, but rents are not growing, right? That's the reality. For the next 12 months, it's going to be a fight for occupancy. You're not going to get the relief of 5, 10, 15% organic rent growth. And if the 10-year stays where it is, you're not getting a tremendous amount of rent relief on your fixed rate relief on your fixed rate financing. So we continue to believe that there is opportunity out there that's hanging in the shadows. It's taking a lot of work, but there will be some more urgency coming into the market. We do believe it, and we are well prepared. We are net buyers. We want to be active. We want to maintain our disciplines for sure, but at the same time, we believe this is a great opportunity between now and all throughout 2025 to accumulate as many good assets in good markets for the long term that we possibly can. So we'll continue to do what we do and try to source unique opportunities while we wait and see if there becomes more of a widespread dislocation or disruption in the space. But we are not. I think one thing to really highlight to both potential new investors and those industry professionals out there that we've never worked with before is that we are not exclusive to one profile of deal. We're private capital, so we are opportunistic by nature. We are looking for value at the end of the day. I know everybody says that, but we mean that, right? So we will go buy a vacant 288 unit property with 400 violations on it and do a $10 million renovation. We will buy a 2001 Core Plus 248 unit deal from a 15-year owner that we can go do a $3-4 million value add to. We will buy a 50% loan assumption, that's just being poorly operated because we feel we can get value. And simultaneously, we will build a brand new ground up, Class A institutional asset at the right basis. So, we are open to all opportunities. We can move quickly, and we're excited for what's in store. So as we wrap up here, if you're interested in learning more about URS Capital, please reach out to Rebecca at urscapitalpartners.com. And for those brokers out there that may be watching this or owners, our target markets, we are pretty disciplined in that. I'd say the only ones to add here is kind of the Cincinnati, Northern Kentucky area. We started our business in that market, and we'd love to get back there. But North Carolina, South Carolina, Tennessee, and Savannah are our target markets. And I hope you enjoyed the update. Thank you.